Salesforce reported its earnings in Q4 after the market closed on the 26th of February, and investors have since been selling out of their positions, with the stock currently down around 3% in the pre-market and over 14% in the past month. Today I'll be going through the earnings report itself, analyst expectations, and why I believe the market doesn't really like this report, before discussing my own position and whether Salesforce is a buy at these current levels. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So here we have one of the articles surrounding the earnings report that Salesforce just brought out yesterday. And in this report, they say that the Salesforce missed on their revenue and issued disappointing guidance in relation to 2025. And that's kind of true. If we look here, we've got their earnings per share, which sits at $2.78 adjusted versus the expected $2.61. So it shows quite a good beat there around about the 7% mark. And then we've got their revenue guidance, which came in at $9.99 billion versus $10.04 billion expected. Around a 0.5% beat or loss there, sorry. So if we look at that from a general basis, that looks like the top line revenue hasn't grown as expected, but the EPS and profitability of the company still looks rather good. However, I do think this is one of the reasons this company is selling so much just after earnings. I think people look at the initial revenue drop and miss as very bad and are very concerned by it. So that is why we're seeing maybe a drop in the share price at the moment, along with guidance. Now we have Salesforce quarterly results, and this is their initial front page that they've got here. One thing I noticed firstly, because I look at quite a few of these reports, is what was right at the top. So here we have the full 2025 Agentforce and Data Cloud sort of revenue growth and stuff like that. So they're talking about Agentforce straight away before they're talking about their quarterly results, which is noticeable. They said that 900 million Data Cloud and AI annual recurring revenue was up 120% year over year. So this is the first thing they want you to see. They want you to see that they are growing recurring revenue in Data Cloud and AI 120% year over year, which is obviously sounding very impressive. But if we look at it in relation to another quarter, Q3, for example, in 2024, in December, right at the top, we have the first thing we notice is third quarter highlights. And they talk about their revenue guidance there of 9.44 billion, up 8%. Q2, exactly the same. Second quarter revenue of 9.33 billion, up 8%. Q4, a full quarter result, all the way back a year ago, they brought out their fourth quarter revenue results up 11% year over year. So we've gone from a fourth quarter revenue of 11% year over year growth to around 8 to 7%, which is not good. But also I'm noticing the fact that in this particular report, they want to talk about Agentforce. They do not want to be talking about their fourth quarter results, which I thought was a little bit telling, but that could be because I'm being a bit pessimistic. But from my interpretation of just looking at it quickly, they want you to focus on this and not focus on these results. Just my perspective. But looking at the actual report itself, there was a few good things and a few bad things. The first thing that I took that was quite positive was this 900 million Data Cloud and AI annual recurring revenue. That's obviously a profitable subscription that's doing very well, 120% year over year, which is very impressive. Will be growing in terms of its possibilities and revenue streams for the business. And since October, they've said they've closed 5,000 Agentforce deals, including more than 3,000 paid, which is very positive. It shows that Agentforce has got quite a bit of demand and could become a very good recurring revenue source for the business. And one other thing that I thought was very telling from this initial sort of 2025 Agentforce and Data Cloud guidance and achievements that they've already said about was on help and salesforce.com, Agentforce has handled 380,000 conversations and achieved an 84% resolution rate with only 2% of the requests requiring human escalation. Now that's huge if it's true. Now, some people are saying it's not true, saying this number is inflated, or there is some other reason for this sort of metric to exist. But if they have actually achieved 84% resolution rate for what is essentially a bot answering conversations, then that's huge because people do not like bots. They don't like speaking to them. They get frustrated by them. They want to speak to a human. And more often than not, that results in more handiwork for a company. But Agentforce is showing, at least in this one particular sort of statistic, that they are overachieving in that area and achieving an 84% resolution rate, which I think is huge if true. And we'll have to see how that develops as time goes on. Now, if we look at 2025, their results, this is where we get to one of the first things that I think is causing people to maybe sell out of their positions or sell and trim their positions. It's got their fourth quarter revenue of 10 billion, although we said it's 9.99 billion when you look at the actual statistics, up 8% year over year, 9% on a constant currency basis, which is a considerable slowdown from a year before about 11%. So obviously that's not ideal, and I think that's including me in that as a shareholder. I don't like to see that in my companies. I want to see growth above 10% in revenue, and that is one of the reasons I bought into Salesforce, despite other reasons. So I don't like to see it, and it's one thing that I'm keeping an eye on for the future. But then we get onto a bit more of a positive for Salesforce, and that is their growing profitability story. Now, this is one thing that I noticed when I was buying into the company when sentiment was really bad. No one was talking about these two particular things. Operating cash flow of $13.1 billion, up 28% year over year, and free cash flow of $12.4 billion, up 31% year over year, which is just huge. They've grown their free cash flow at 31% year over year. It's just a massive figure that is very good, and it shows that they are increasing their operating margins and doing very well. So I really like to see it. I love the fact that this is a growing source of profitability and is going to really help out businesses. And one way where I want to show this and epitomise how quickly this has happened over a space of time is show you a few different little graphs. This is a graph for Salesforce over the past, say, 5 years from 2020. And it shows in the bars here their free cash flow growth. We can say that it's grown, and as it shows it's grown, we can see by how much. It's grown by a CAGR of 27% over the past 5 years, which is huge, and mainly due to margin expansion, not just revenue growth. And in this particular graph, we've got their first line here, which is gross profit margin. That has stayed pretty much the same. It's fluctuated around the mid-70s, but it's now still sitting around the 76%. And then if we look at this orange line here, jumping around the graph, we've got their operating margins. And that has grown from 2.7% in 2020 up to 19.7% in 2024. So to me, we're seeing a massive margin expansion and change. And this is something I noted when I was buying into the company around here. So we saw this change here, and this is when the share price shot up. And then we've got the free cash flow margin, which has also grown. Back here in, say, 2021 in January, they had it about 19%. It's now sitting around 31%, not quite doubled. So when we look at these things, we need to understand how this company has now become very profitable. And now their free cash flow is sitting over 12 billion. So we're seeing a very good profitable trend with this business, despite that slowing revenue growth. Back to the report. I like seeing that operating cash flow and free cash flow grow year over year. And their returns on their investments through two different things to shareholders. They have their 7.8 billion share repurchases that they did in 2024, which is good to see. Trying to cut down on that stock-based compensation that they so heavily added to before. And 1.5 billion in dividend payments to shareholders. So they're growing their dividend quite well, which is nice to see as a originally dividend growth based investor that I am. So I like those things. So I think we've got two different things there that are very good. Margin expansion and operating and free cash flow growth is very strong. Returns to investors as a form of share repurchase and dividend investment is still strong as well. But the revenue growth on its own is not looking great. And then we've got a full year 2026 guidance, which is actually for 2025 as they do it a year in the front. And they've initiated revenue guidance, which is also the other thing that I think has people selling out of this position a little bit, which is a guidance of $40.5 billion and to around $40.9 billion, up around 7 to 8% year over year. So they've guided for another year of downwards revenue growth, which is not ideal and something, even if you're being conservative side, is still not nice to see. Additionally to that, they've also said something that I don't really like to see as well in their forward guidance. They've initiated operating cash flow growth guidance of approximately 10 to 11%, which is just not really as quick as I was hoping for. I was hoping more for the 12 to 13% sort of range maybe, and I don't think that this is necessarily as fast as what I was hoping for in terms of operating cash flow. So overall, I didn't think this was necessarily a bad or terrible report. I thought it was a bit of middle of the road one, but also a little bit of an eye-opener one as well. They are focusing on agent force as a big driver for revenue, which I think is a positive outlook for the company. I do think that that will probably work very well for them if it is performing as well as they say it is, but they could be embellishing. So it will have to develop a little bit from the earnings recall. I think that a lot of people will have questions surrounding this agent force 380,000 conversations. I think there'll be a lot of probing around that. And I think people will ask about the slowdown in revenue growth. And it's the same story, if I'm honest. It's a more mature business, but it's not growing as quickly as investors were maybe hoping for, and that's led to a little bit of a sell-off. Additionally to that, we're also seeing the operating cash flow growth guidance come down a little bit. And we're sort of saying now that margin expansion they're experiencing and continue to experience into the future is still improving, but not going to be improving as quickly. So we're going to see a massive slowdown in that. And as a shareholder for me, I think there are good points and bad points with this report. So I don't think that there's necessarily a massively bad take on this report overall. Now we can ask ourselves whether Salesforce is a buy at these current levels we're seeing, around $295 per share. And it's something that you constantly have to ask yourself as an investor, because you need to know if you should be allocating more money to a position, if it's down, and see whether to continue to add to positions that you are already invested in. In this particular case, we're going to be using free cash flow, do a 5-year analysis, and we'll do a metric growth rate that is well below what we are actually likely to get. The main reason for this to be on the conservative side is because we are predicting 5 years into the future. A lot can change with companies, and it is better to be on the conservative side. In this particular case, their annual cash flow growth over the past 5 years is 28%. Obviously, we are not likely to receive something like that in the future. That was mainly due to margin expansion, and as Salesforce have said, that is slowing down. So, in this particular case, we've gone for an 11% growth rate. That is probably on the conservative side for Salesforce. I would have said they're probably more than likely growing around about 13%, but this is where I want to start off. Salesforce dilutes shares a little bit, so I've added about a 1% dilution of shares, allowing for some buybacks, which they've been doing, but the stock-based compensation is still a factor. Dividend growth, I've said about a 15% growth rate, and a price ratio for free cash flow sitting what it sits at now, because it's not growing as quickly as it was in the past. This average price free cash flow over the past 5 years is 36, but it won't trade at that again, I don't think. In my mind, it would only trade at that because people are pushing up the price surrounding AI, and not because if its fundamentals. Its fundamentals are now sort of middle of the road, single digit revenue growth for a mature business, rather than double-digit revenue growth that they were getting 5 years ago, around about 15% or more. So it's not going to be priced in that way in the future, if you ask me. So if we allow for that with the 24 price to free cash flow, then we get around about a CAGR of about 10.63% over the next 5 years. And that is a fair value around $316 per share, and very close to the share price of $295 now. So if you ask me, this is one that's trading around fair value. I wouldn't say it's undervalued anymore, and I wouldn't say it's overvalued anymore. And I would actually say that if you're thinking of getting into this position, you need to understand that the business is more mature. It's got a growing profitability story that is very successful and likely to reward shareholders, but there is the slowdown in revenue growth, and that will lead to earnings reports maybe trading down like it is currently. So what am I doing with my shares? I have around about a £4,600 position in Salesforce, around 20 shares. We're up by about £728. And I initially sort of trimmed out this position. I sold about 33%, around 10 shares, around $341 mark, something like that. And now it's obviously come down by quite a bit. That was mainly because I thought the money could be put to better use elsewhere, and I put it into Google, and it's done fairly well in that time, but also come down. So I would say that I like Salesforce profitability and sort of cash flow growth into the future. But for me, I think there are still concerns surrounding the business's slowdown in revenue growth, and there is still concerns whether Agent Force can fill that gap. I hope that they can. As a shareholder, I kind of believe that they maybe will, mainly because there's lots of interest around Agent Force. I've heard about it up in London where I work, and generally I quite like that sort of maybe growth line for the business. But one thing I would like to say about this particular position is that this revenue growth slowdown is not specific to mature businesses. So generally speaking, mature businesses grow slow, we know that. But there is some businesses that are still very mature, more mature than Salesforce, but are still growing quickly that I've got my eye on. And one of those is Microsoft. Now, if we look here, they are still growing revenue by over 12% in the last quarter. And that's compared to Salesforce's growth of about 7 to 8%. So I have to weigh up whether I would rather own Salesforce or Microsoft at these current levels. And if Microsoft continues to come down and Salesforce continues to maybe trade flat or trade up off this earnings report, maybe if the market goes a bit different way today, I would see myself maybe doing a switch. Maybe not Microsoft, maybe Google, but I could see myself maybe switching out of Salesforce. And that is because of concerns surrounding their revenue growth. But that's just me. It may not happen. It may not materialize. I'm still investing in the business. I still love their business profile and whole sort of outlook. But I just do not like this slowdown in revenue that we're continuously seeing. And when I invested in the company originally, it was still growing around 11%. But that's just me. So that's all I've got to say, really. I hope you guys looked into this earnings report yourself. What did you think of it? Did you really like it at all? Or was there concerns that you had as well? Feel free to put them down below and I'll answer all your questions. Thanks for watching. I appreciate it. And I'll catch you in the next one.